Hello, my name's Charles Lastic. I'm the Managing Director of Blue Bond Tax Planning. We've been specialist inheritance tax planners for more than 18 years and have helped hundreds of clients save millions of pounds on their inheritance tax. So today's video is of an unusual nature in that it's aimed more at non-domiciles than our usual client base. This is videos around something called an excluded property trust. However, it is very useful for saving literally all types of tax, income tax, capital gains tax, inheritance tax, for people in a couple of different scenarios. For instance, if you are not yet domiciled in the UK, and you may well become because you're intending to live here long term, or as in an awful lot of cases where people have settled here in the UK and become domiciled, but their parents, for instance, may be non-domiciled with lots of assets offshore, which they're now going to leave to their UK beneficiaries. So an excluded property trust can save tax for both of those types of people, and that's what today's video is around. So how does an excluded property trust save tax for non-UK domiciles? Now, setting up an excluded property trust can be highly beneficial for people who are currently classified as non-UK domiciled, but who already hold significant offshore assets. Now, the rules for an excluded property trust are different than they are for UK trusts because these are offshore trusts set up in offshore jurisdictions. Now, it will cost a few £1,000s to set up and at least £1,000 a year to run and maintain to pay the costs of the offshore trustees. Now, they can be set up in different offshore jurisdictions. We work with a number of different countries, including the Channel Islands, the Isle of Man, the Cayman Islands, Cyprus, and we will explain to you the different jurisdictions and the different costs involved in setting up these arrangements. So why set up an excluded property trust? So it really can save a huge amount in different taxes, including income tax, capital gains tax, and inheritance tax for people with two main scenarios. So firstly, people who are likely to become UK deemed domiciled. In other words, you have lived or are going to live more than 15 out of the last 20 years in the UK, or you intend to permanently settle here even though you weren't born here in the first place. And the second type of people is for people who are non-domiciled. They don't live in the UK, not even resident in the UK, but they intend to leave significant assets to potentially their children or grandchildren who are already UK domiciled. They lived here 15 in the last 20 years, or potentially were born in the UK. So people offshore leaving assets to UK domiciles. That's effectively the second classification of people. So as the first scenario concerns people who are going to become UK domiciled, you must understand that these excluded property trusts only refer to offshore assets. It's nothing to do with any UK assets. Okay, so however, it also has to be done before you become a UK domicile. So you're intending to live here long term, you haven't lived here 15 out of the last 20 years, you're going to become UK domiciled, and you can set up an excluded property trust before that occurs for your offshore assets, to be absolutely clear. Now, once the excluded property trust is set up, it's possible to borrow the assets from your own trust. So even though you put the money in, because as I said, the rules are not the same as that they apply to the UK. So if you borrow from the money from the trust, it's not that that's an income from an offshore asset. You borrowed it, so it's not subject to UK income taxes. Then on death, the debt is payable back to the excluded property trust because it's a borrowing, which then reduces your asset base for inheritance tax, even though you may have already become UK domiciled by the time you die. Now also, if you want to manage offshore, your assets offshore for whatever reason, you want to manage it in dollars or euros or whatever, then you can have an investment portfolio or properties or whatever offshore owned by that excluded property trust. Any income into that trust is then borrowed by you, not subject to taxes, not even has to be declared, because in actuality got nothing to do with HMRC, because the assets are owned by an offshore trust subject to an offshore jurisdiction, and therefore it's not subject to UK income taxes or capital gains tax, but you've got use of the money. Okay, now if you bring money into the UK and then you invest it in the UK, obviously that will then be subject now to UK inheritance taxes. But if you're just borrowing the money and spending it for your lifestyle, no, not subject to UK tax at all. So if any money taken out is considered borrowed, therefore no income tax is payable, but you do need to pay interest back to your excluded property trust to make it an arm's length transaction. But however, obviously that interest is for your own trust and therefore for the benefit of your own family. So the second scenario is people who are not UK domiciled, they live in France, Spain, any other part of the world, the US, but they intend to leave assets probably to their children who are resident in the UK and are going to be domiciled in the UK. And if they leave all of those assets to a UK tax resident or domicile in the UK, those assets will then be subject to UK income tax and obviously to UK inheritance tax. Also, obviously, if you're leaving it directly to those people, then if those people get divorced, there is no protection around the asset either. So you can set up an excluded property trust during lifetime. Now, because there are ongoing fees of at least £1,000, it obviously makes sense to put assets in there during lifetime. But if you're intending to gift money to your children who are based in the UK, you can gift the money into the excluded property trust. The children can then borrow the money. Of course, you'll have that £1,000 or so of fees to pay your offshore trustees, but if the amount is of significant value, then that's well worthwhile. So you can set up the excluded property trusts, and actually you should, during your lifetime. So we would help you to do that. Then on death, when you're passing a whole bunch of other assets, your wills can then pass the assets to the excluded property trust as opposed to directly to your UK resident beneficiaries. Those beneficiaries, as I said, can then borrow the money from that trust, thus avoiding being subject to income taxes or UK inheritance taxes. And when they die, the money is payable back, and therefore inheritance tax is not payable. So the monies can be managed offshore, as I said, in exactly the same way, which makes it exempt from UK capital gains tax, which is very, very low in the next couple of years. And obviously it also avoid any income tax charges on the trust itself, whereas UK trusts are subject to quite stiff tax charges. So all in all, an excluded property trust for the right types of people, domiciled, or people who are not domiciled at the moment. This is a very, very useful tax saving strategy for people in those scenarios, but it does require experienced help and advice. You absolutely must not go into this directly without getting good help and advice, because you will make mistakes and therefore come afoul of HMRC. Okay, so get help and advice. Hopefully you found that video useful. Thanks and goodbye for now. Bye.